a cash value life insurance policy and how we might use that cash to invest in real estate. All right, so let's say that we have a property here and that property's value is $200,000. We'll use nice round numbers here. Okay, so we have $200,000 in a policy, we have $200,000 in a bank account, and the property is worth $200,000. Nice round, easy figures. Now, let's just say for this example that we need 20% down, which would be $40,000, right? So we need $40K to put as a down payment on this property. So where do we pull the cash from? Well, we could take it out of our cash in our bank account, and we would just deduct our $40,000, leaving us with $160,000. That buys us the property. Or on the life insurance side, we could take a policy loan for the $40K. With that, the entire $200,000 continues to stay intact and continues to compound at that 4% guaranteed rate each and every year, right? So we take the $40,000, we use it to purchase the property on both sides. Now, let's say in this example that the property spits off $500 a month in cash flow. And the question becomes, what do we do with that cash flow, right? So most people might say, well, it's my cash flow. I want to send it right back to myself, send it back to my pool of money. What a lot of the real estate agents and advisors that we work with or investors look at is they go, well, couldn't I use some of that cash flow in the beginning to pay back this policy loan? We know that when this loan comes out from the insurance company, it's not as simple as just free money, right? It's typically at a minimum of about 5% simple interest. And while there's no terms as to why and how and when we pay it back, we know that at least it's going to accrue at 5% simple interest every year, which is $2,000 per year. So we know that that's happening, right? So what a lot of the investors will do is they'll go, okay, well, I want to actually redirect this cash flow a little more effectively. So what if I were to take this $500 in cash flow and look at it as if that $40,000 was a loan that I took out for myself? So they take the $500 in cash flow and they go, okay, what if I made payments back to myself for, I did the math on the back of a napkin here, for 8 years at $500 a month, I would pay back the entire loan in that period of time. Right? So that would have paid off this entire loan, and that would have been completed. Now on the bank side, if I were to take that $500 and just put it back with the rest of my money, the $160,000 that I have in that bank account, just feed the $500 in each and every month. The $500 over an 8-year period, same 8-year period, would be about $48,000 total in cash flow that I would have pulled back. So here I'm repaying myself, making myself whole again, and here I'm repaying my loan. So the question becomes, well, why did I want to take the loan? What's the difference here? And for us, we like to look at the end of the day, right? At the end of this, let's just call it the 8-year period for now. Where do the two kind of balances line up? Where's the advantages and disadvantages? Well, if we look at the policy side, remember, this $200,000 was growing and compounding each and every year at 4%, regardless of this amount here that was taken out, which means that after the 8-year period, we had paid off the loan. And that also means that this value here, or what this grew to over that 8-year period, if I just take $200,000, we're assuming it broke even. I'm taking nice round numbers and some assumptions here and saying 4% minimum guaranteed each and every year. That would have turned into something like $273,700 over that 8-year period. That's what the cash value swelled to or grew to because of the 4% guaranteed, right? It's a big number. Get 70,000 plus in growth there. On this side here, we took the 500 and we just kind of put it back into our policy. Well, where are we at this point? Or we put it back in our bank account. Well, we had 160, we put 48,000 in there. At the end of the day, we have about 208,000, right? Still a positive return. At the end of the day, we still purchased this cash flowing asset that we own outright in 8 years. Well, we don't own outright. We've paid off the down payment on, we still have a mortgage or something else that's buying that asset. But we purchased that asset with the cash that we had. So when we talk about this, it's not so much just fixating on the interest rate that you have to pay. Oh my gosh, I have to pay an interest rate for my own money. Yes, you do, but you have to think about the long-term repercussions of what this cash is doing in its different locations. Because if it sat in this bank account, it just sat at $160,000 and never grew again, right? It just sat there and did nothing. There's an opportunity cost that you lose out on by taking that $40,000 out of the account and not letting it grow. Whereas on this side, we let the $40,000 stay with its friends in the total amount here, and it continued to appreciate, bringing us a nice large amount of money over that same 8-year period. So it's just two different methodologies. There's not necessarily one that's over the other, although the investors that we work with certainly like to see much more growth with their cash, and it's pretty obvious why, but some people don't like to have this idea of a loan outstanding. So the cash flow, it's purely up to you, of course, but this is one of the advantages of why people like to redirect cash flow to repay the cash they take out from a loan. It helps them to pay down that loan quicker. They don't see it because the property is positive and is spitting off that cash flow. And they know that their large nest egg isn't being interrupted and they're getting that long-term growth, right? So we're looking at this just over 8 years. What does that number look like at 20 years, at 30 years? That's just gonna keep going up and up and up. Where on the bank account side, okay, you've made whole again, you're at 208,000. Start the process all over again. You find another property, you pull out 40,000 and you start over and you spend 8 years paying back that cash flow in if you wanted to do that, right? So just two different sides of the coin here, but you can see some of the advantages of why our investors like to use this strategy because it optimizes it. They didn't spend any more money, right? There was a little bit of interest that they ate in for sure, but look at what it did overall for the growth. So it's almost like giving up a little bit of interest to make a lot of interest. So it's just two different ways to look at it, but that's just an example of how you can get creative here and really optimize how you use your cash.